In ancient Siam, when the king wanted to destroy a rival without lifting a sword, he didn't send an assassin. He sent a gift, a white elephant, rare, sacred, and utterly ruinous. You couldn't refuse it, and you couldn't work it. You had to feed it purely for the prestige of owning it, while it slowly, methodically ate you out of house and home. The global economy is no longer a machine we operate. It is a white elephant, and for the last 2 years, we've been told the beast is healthy. We were told the landing was soft, that the recession was canceled. But then, the glitch. Use your eyes. Look past the inflation adjustments and the government revisions. Look at the one demographic that stops spending when the system is working. The impervious class. The 1%. They just stopped. According to the latest 2025 data from Bain & Company, the global personal luxury goods market didn't just slow down, it contracted. A decline of roughly 2% to 5%. That number sounds small. It isn't. It is the statistical equivalent of a heart skipping a beat. This is the first true organic demand collapse since the 2008 Great Recession. But the mechanics are different. This isn't a subprime mortgage blowing up a bank. This is silence in the VIP room. For 5 years, from 2019 to 2024, brands like Chanel and Hermès played a dangerous game. They hid the rotting demand by raising prices. Chanel hiked prices on classic bags by nearly 9% in early 2025. Hermès by 7%. They thought you wouldn't notice that they were selling fewer units as long as the revenue line went up. It was 80% price inflation and 0% volume growth, a Potemkin village made of leather and gold. But in 2025, the math broke. Gucci revenue plummeting 18% in the first half of the year. LVMH stalling. The aspirational consumer, the middle-class striver buying a logo belt to feel wealthy, has been vaporized, gone. Bain estimates the luxury consumer base has shrunk to 330 million people. That is tens of millions of buyers who simply vanished from the marketplace. Why does this matter to you? You don't buy Birkin bags. You're trying to buy eggs. It matters because the luxury market honest sector left. It isn't subsidized by food stamps. It isn't propped up by government stimulus checks. It acts on pure, discretionary liquidity. When the rich stop spending, it means the smart money sees the cliff. They are hoarding cash. They are liquidating assets. They are building the bunker. We called it a Richcession at first. A cute headline for Bloomberg. The idea that this downturn would only hurt the guys with the yachts. That is a lie. When the wealthy retreat, the capital structure that employs the service class evaporates. The waiters, the contractors, the drivers, the logistics managers. The white elephant is starving. And when a beast that size gets hungry, it doesn't graze, it rampages. The media is still talking about interest rate cuts saving the day. They are looking at the lagging indicators of 2024, but the signal has already flashed red. The contraction at the top is the precursor to the collapse at the bottom. If those with the most capital in human history are suddenly afraid to part with a single dollar, what do they know that you don't? They know the era of easy growth is over. They know the debt cycle has turned. And they know that what comes next isn't a soft landing. It's the echo of 1989, and it's getting louder. And it's getting louder. But to hear it, you have to stop listening to the noise of the stock market and start listening to the silence of the things that Times used times to signify wealth. We assume luxury assets hold value. That is the great lie of the upper middle class. We buy the watch, the car, the vacation home, believing that in a worst-case scenario, these are stored energy, liquid capital. But in 1990 Tokyo, at the absolute zenith of the biggest asset bubble in human history, the ultimate status symbol wasn't a Patek Philippe. It wasn't a Ferrari. It wasn't even a penthouse in Ginza. It was a piece of paper, a golf club membership, To understand what is happening to the global economy right this second, you have to understand the insanity of the Nikkei Golf Membership Index. Yes, that was a real thing. In the late 80s, corporate Japan wasn't just buying Rockefeller Center and movie studios. They were buying access. And in a culture obsessed with hierarchy, the fairway was the boardroom. But land in Japan is scarce. It is mountainous. It is finite. So, the private clubs didn't just sell the right to play. They sold tradable securities. These memberships were listed on exchanges. They had brokers. They had daily price fluctuations. You could borrow against them. You could leverage them. A bank would look at that piece of paper and say, yes, this is collateral. And because money was free, because the Bank of Japan had opened the floodgates, prices detached from reality. They floated into the stratosphere. Let's zoom in. Take the Koganai Country Club, a beautiful course, West Tokyo, impeccable greens. But in early 1990, if you wanted to walk through those doors as a member, you didn't pay an initiation fee. You paid a ransom. At the peak, a single membership at Kogani traded for 3.5 million US dollars. 3.5 million. Not for the land, not for ownership of the business, just for the times, privileged times of making a tee time. For the price of a membership at one golf course, you could have bought a commercial skyscraper in Dallas. You could have bought a fleet of aircraft. But nobody in Tokyo was buying skyscrapers in Dallas. They were buying the membership because the chart only went up. It was the infinite money glitch of the Heisei era. A businessman would buy it for 200 million yen on Monday, and by Friday, he'd ostensibly be worth 220 million. He felt rich. He spent like he was rich. He took out loans based on that phantom wealth. This is the psychological anchor I need you to understand. Wealth isn't what you own. Wealth is what you can times sell asterisk. And in late 1990, the buyers vanished. It didn't happen all at once. It wasn't an explosion. It was more like a leak in a pressurized cabin. A few nervous executives tried to cash out to cover real estate losses. They called their brokers. Find me a buyer for Kogane. Silence. Lower the price to 3 million. Silence. 2 million? Nothing. This is the phase of the collapse that terrifies me the most. The no bid phase. When you look at a stock chart, you see a red line going down. You think, oh, people are selling at lower prices. No, that's not what a crash feels like on the ground. A crash feels like paralysis. The quote on the screen might say the membership is worth $2 million, but if you can't exchange it for cash, it is worth times 0 asterisk. Actually, it's worth times less times than 0, because you still owe the debt you took out to buy it. Then came the Ibaraki Country Club scandal. Ibaraki was supposed to be the gold standard, but as the desperate members tried to liquidate, they peeled back the curtain and found a rot so deep it destroyed the sanity of the market. The club had oversold memberships. Imagine selling 1,000 tickets to a theater with only 100 seats. They had issued thousands of exclusive memberships that didn't technically exist, pocketing the cash to speculate on other assets. It was a Ponzi scheme wrapped in a polo shirt. When this broke news in 1992, the illusion shattered. The Nikkei Golf Membership Index didn't just correct, it evaporated. It fell from an index value of over 1,000 to nearly 0. Total losses? 9.5 trillion yen in unpaid membership deposit claims. Let those numbers vibrate in your skull for a moment. 9.5 trillion. That is an entire generation's wealth, wiped out not by war, not by plague, but by the sudden realization that a luxury asset had no intrinsic utility. By 2003, nearly 200 courses had gone bankrupt. The manicured greens turned into weeds. The clubhouses, once filled with the laughter of the invincible salarymen, sat dark, dust gathering on the mahogany lockers. Why am I telling you about Japanese golf in the 90 seconds? Because look around you. Look at the luxury assets holding up the balance sheets of the modern upper class. The digital monkey JPEGs. The vintage Rolex market that doubled in 2021 and is now softening. The vacation Airbnbs in Joshua Tree that are sitting empty because the passive income dream died with high interest rates. We are currently living in the Koganei era of the Western world. We have convinced ourselves that things are worth millions because someone else times will pay millions. We have confused price with value. But the liquidity cycle is turning. The tide is going out. And just like the Tokyo businessman in 1990, you are staring at a portfolio that says you are a millionaire while the phone on your desk refuses to ring. You are waiting for a buyer who isn't coming. The silence is deafening. And in that silence, you start to notice something else. Not just the assets losing value, but the systemic structure underneath them starting to crack. You see, a crash doesn't just lower prices. It reveals the lies. It exposes the Ibaraki country clubs of our world. And once you see the fraud, you can't unsee it. The signal is already flashing red. Most people are just too distracted by their phantom wealth to look up. But you're looking right at it. You're looking right at it. And the first thing you see isn't a chart. It's a ghost. The ghost of Tokyo 1989 is now walking down Market Street in San Francisco. Walk with me. Step over the broken glass on Yerba Buena Lane. Look up at the 4 lease signs that have been bleached by the sun. They aren't temporary. They are tombstones. Global commercial real estate isn't just correcting. It's rotting. In the Yerba Buena district, once the beating heart of tech retail, vacancy rates are hovering near 40%. 40%. Let that number sink in. That isn't a downturn. That is an evacuation. If you walked into a hospital and 40% of the beds were empty because the patients had died, you wouldn't call it a slow season. You'd call it a plague. But the media tells you San Francisco is a unique case. They tell you it's bad policy. They tell you it's just the homeless crisis. They are lying. San Francisco is just the first domino. It is the canary in the coal mine, and the canary hasn't just stopped singing. It's decomposing. Now, shift your eyes from the empty storefronts to the wrists of the men who used to own them. For the last 5 years, we were told that luxury watches were an asset class, that a Patek Philippe Nautilus was better than gold, that it was a store of value that could outlast the dollar. Wrong. The secondary market for luxury watches has collapsed to 3-year lows. The Bloomberg Subdial Index, the ticker tape of the ultra-wealthy, is bleeding out. Why does this matter to you? You don't own a $50,000 watch. It matters because this is the liquidity signal. When the rich feel rich, they buy time. When the rich are scared, they sell it. They are dumping their assets. They are unloading the Pateks, the Rolexes, the beach houses. They are raising cash. And when the smart money rushes for the exit all at once, the door jams. Prices plummet. The illusion of forever value evaporates. They know what's coming. And what's coming is hidden in the debts of the companies that employ you. Look at the corporate bond market. This is the engine room of the American economy. It's boring, it's complex, and it is currently on fire. Moody's Analytics is now projecting the U.S. speculative grade default rate to hit 9% by the end of 2025. 9%. That is nearly 1 in 11 companies. Think about your neighbors. Count 11 houses on your street. One of the breadwinners in those houses works for a company that is mathematically destined to die this year. This isn't a projection of a soft landing. A 9% default rate is a crash landing into the side of a mountain. These companies survived the last few years by borrowing cheap money to pay off old cheap money. It's a Ponzi scheme sanctioned by the Federal Reserve. But the cheap money is gone. The refinancing wall is here. And they can't pay. So what happens when the default rate spikes? Layoffs happen. Not the trimming the fat kind. Improved efficiency? No. This is padlock the doors kind of layoffs. The bond market is screaming. The luxury market is liquidating. The commercial real estate market is already a corpse. Most people see these as three separate news stories. Oh, San Francisco is unsafe. Oh, watches are getting cheaper. Oh, business is tough. They see noise. But you see the signal. It's a frequency that only plays right before the levee breaks. The rich are cashing out. The corporations are defaulting. The storefronts are empty. The economic tectonic plates have already shifted. The earthquake has happened out at sea. Everyone else is still playing on the beach, looking at the tide pulling away, wondering where the water went. They think it's a calm, low tide. They don't know, but you do. You know that when the water recedes that fast, it's not leaving. It's gathering strength. The wave is coming, and the only question left is how high is the wall? The wall isn't made of concrete, and it isn't made of numbers. It's made of water. Look out past the breakwater, past the for-lease signs on the shore, out into the silence of the harbor. There it sits, a jagged silhouette against the gray twilight. 160 feet of composite aluminum and reinforced glass, a $50 million superyacht. From the shore, it looks like the ultimate symbol of mastery. It looks like freedom, but you know better. You know that it's not a vessel. It's a cage. Zoom in. Get close enough to hear the hum of the generators. They never stop running. If they do, the mold begins to bloom behind the Italian leather panels within 48 hours. The hull requires constant divers to scrub the barnacles. The crew, 12 of them, need salaries, visas, food, insurance. The dockage fees in Monaco or Miami rival the GDP of a small island nation. And here is the math that the brochure didn't mention. In 2025, the operating cost of a vessel this size isn't an afterthought. It is a mathematical certainty. 10 to 15% of the purchase price every single year. That means this $50 million monument to ego demands $7.5 million in cash just to exist. 7.5 million every year. Whether you use it or whether it sits there bobbing in the dark, this is the white elephant of Chapter 1, fully grown and starving. And in a bull market, that cost helps you sleep at night. It's the price of entry. But we aren't in a bull market anymore. We are in the death spiral. The owner of this boat is currently staring at a spreadsheet in a penthouse that is also losing value, realizing he is bleeding to death from 1,000 cuts. He wants to sell, but here is the horror of the liquidity trap. To sell, you need a buyer. And the buyers have vanished. They've seen the same data you have. They're hoarding cash. They aren't catching falling knives. So the owner has a choice. Drop the price? If he lists it for 40 million, he admits he's lost 10 million. His creditors get nervous. The bank calls him. They ask about the collateral on his business loans. So he keeps the price at 50 and he waits. And while he waits, he bleeds. Day after day, the crew eats. The fuel burns. The insurance premiums tick upward. He is trapped in a prison of operating costs. And this floating prison is the perfect metaphor for the entire global economy in 2025. Because it's not just the billionaires suffering, it's the corporations that employ you, the companies in your 401k. They are all sitting in that boat. Let's leave the water and go into the boardroom. The mechanics are exactly the same. In 2025, corporate America hit the wall, but they didn't call it bankruptcy. That word is too ugly. That word scares the algorithms. Instead, they found a new phrase, a polite euphemism for financial suicide, the distressed exchange. It sounds technical, doesn't it? Almost professional. Here is what it actually means. A company owes $1 billion. They can't pay it. In a sane world, they would file for Chapter 11. They would liquidate. The assets would be sold. The bad debt would be flushed out of the system. But we don't live in a sane world. We live in a world of optics. So instead of defaulting, they go to their lenders. They lock the doors. The air conditioning hums just like the generator on the yacht. They look the bondholders in the eye and they say, "We can't pay you, but if you force us into bankruptcy, you get zero. So here is the deal. We will trade your dollar for 50 cents of new debt, and we will push the deadline back 3 years." It's a haircut, a massive one. The bondholders take the deal. Why? Because 50 cents on the dollar is better than zero, and because they don't want to mark the loss on their own books either. Everyone shakes hands. They sign the papers. They announce a successful restructuring, and the zombie lurches forward. But look at the data. Look at what happened in 2025. According to S&P Global, the headline default rate looked manageable. People on CNBC told you things were stabilizing. They were lying. They were looking at the wrong column, because nearly 55% of all corporate defaults in 2025 weren't bankruptcies. They were distressed exchanges. 55%? More than half the companies that failed didn't actually die. They just entered the death spiral. They traded a quick death for a slow bleed. They are just like the yacht owner. They are trapped in the prison of their own operating costs, refinancing debt at higher and higher rates, shrinking their operations, firing their staff, cutting quality just to pay the interest. This is the liquidity trap. It's not a crash. A crash is fast. A crash is violent. A crash has a bottom. This is a suffocation. It is a slow motion constriction of the entire economic system. When you try to sell your house and there are no bids, that is the trap. When you try to sell your used car and the dealer offers you half of what KBB says it's worth, that is the trap. When a corporation tries to raise capital and the only offer is a predatory loan that strips them of their assets, that is the trap. The liquidity has dried up, the tide has gone out, but the boat didn't float away. It's sitting in the mud, and the cost of meaningful existence is rising every single day. You might be asking, why does this matter to me? I don't own a superyacht. I don't sit on a corporate board. It matters because these companies are the ones signing your paycheck. When a company enters a distressed exchange, they don't just swap paper. They enter survival mode. Innovation stops. Hiring stops. Then the cutting begins. They cut the fat, then they cut the muscle, then they cut the bone. You are the operational cost they are trying to reduce. Just like the deckhand on that yacht in the harbor. When the owner finally realizes he can't bleed $7 million a year anymore, what's the first thing to go? The maintenance budget? No. The hull will rot. The fuel? No. You need to keep the generator running. The staff, the silence you hear in the job market right now, the ghost jobs that are posted but never filled, that is the sound of the distressed exchange. That is the sound of a system that is insolvent but pretending to be alive. And the most terrifying part, we haven't even reached the bottom of the spiral yet, because eventually the bondholders wake up. Eventually, the bank calls the loan on the yacht. Eventually, the extend and pretend game runs out of road. And when that happens, when the distressed exchange is no longer an option, the liquidity doesn't just dry up, it evaporates. Prices go from expensive to zero overnight. That $50 million yacht, it sells for 10. That corporate bond, it trades at 5 cents. That is the moment the floor falls out. We are currently hovering in the split second between the realization of the trap and the snapping of the jaw. So take a good look at that yacht. Shiny, beautiful, ruinous. It's not a trophy. It's a tombstone floating on the water. And the water is rising. And the water is rising. But if the water is rising, and the white elephant, that shiny, maintenance-heavy yacht, is dragging you down into the dark, what floats? Better yet, what doesn't need to breathe? What asset sits in the dark, eats nothing, demands no taxes, requires no polished crew, and has outlived every single currency ever printed by the hand of man. If the previous chapter was about the death spiral of things that consume your wealth, this chapter is about the golden exit. And I use the word exit deliberately, because what we are witnessing right now in the quiet back rooms of the global financial system isn't an investment strategy. It isn't a portfolio diversification. It is an evacuation. The fire alarm is ringing, but the frequency is so low that only the dogs and the central bankers can hear it. Listen closely. For the last 40 years, you have been trained to believe that wealth is a function of yield, dividends, rent payments, interest. You were told that gold is a pet rock, that it does nothing, that it just sits there looking pretty while the S&P 500 compounds your retirement. And they were right. Gold times do nothing. That is its superpower. In a world where every other asset is a liability in disguise, where real estate requires property taxes that are skyrocketing, where stocks require a functioning power grid and a solvent banking system, where bonds require a government that isn't bankrupt. Zero is the ultimate number. Zero counterparty risk, zero maintenance, zero trust required. And the masters of the universe have suddenly realized that zero is the most valuable number on Earth. Look at the data. And don't just look at the number. Look at the panic behind the number. Goldman Sachs, the vampire squid itself, the institution that thrives on the financialization of everything. They aren't telling their clients to buy tech stocks for the long haul anymore. They just adjusted their forecast. Deck 2026, $5,400 an ounce. Let that sink in. $5,400. That isn't a price target. That is an admission of currency failure. That is Goldman Sachs telling you that the dollar in your pocket will bleed out by 50, 60, 70% in purchasing power relative to real things. But they are the conservative ones. Cross the street to Bank of America. Their analysts are looking at the spring of 2026 and seeing something even more terrifying. $6,000 an ounce. Do you understand what the world looks like at $6,000 gold? That isn't a world where your 401k is doing well. That is a world where a loaf of bread is $12. That is a world where the energy grid is intermittent. That is a world where the social contract has snapped. At $6,000, gold isn't a trade. It's a report card on a failed civilization. But here is the part that should make the hair on the back of your neck stand up. It's not the price predictions that matter. Predictions are cheap. Talk is cheap. Watch the hands, not the mouth. Who is buying? If this were just retail investors, scared grandmas and survivalists buying coins to bury in the backyard, we could dismiss it. We could call it a bubble. But it's not grandma. It's the relentless, industrial-scale accumulation by central banks. In 2023, they bought over 1,000 tons, a record. In 2024, they did it again, another 1,000 tons. Now, looking at 2025 and 2026, the appetite hasn't slowed down. It has accelerated. It has become structural. Why? Why are the very institutions that times these paper currencies dumping their own product to buy the one thing they cannot print? Think about that. The Federal Reserve, the People's Bank of China, the central banks of the Global South. They are the chefs in the kitchen. They see the ingredients being used. They know the soup is poisoned. They are front-running you. They are trading their paper luxury, their treasury bonds, their euros, their yen for hard money. They are physically moving bars from vaults in London and New York to vaults in Shanghai, Singapore, and Mumbai. This isn't speculation. This is repatriation. They are taking their chips off the table before the casino closes. And yet, turn on the television. What do you hear? Soft landing, AI revolution. The consumer is resilient. The noise, the distraction, the shiny keys dangling in front of your face while they pick your pocket. They need you to stay in the dollar. They need you to stay in the stock market. They need you to hold the bag. Because if you rush for the exit at the same time they do, the door jams. And that is the crux of the golden exit. It is a door that is rapidly shrinking. Right now, gold is still available. You can walk into a dealer, swipe a card, and leave with metal. The premium is high, but the door is open. But at $5,400? At $6,000? The liquidity dries up. The sellers disappear. Imagine a world where you have the cash. You have the digital numbers in your bank account screaming that you are a millionaire, but you cannot find a single person willing to trade you an ounce of gold for it. That is the moment the door slams shut. We are seeing the capital flight of the century. The greatest transfer of wealth is happening right now, in silence, underneath the floorboards of the global economy. It is a transfer from those who trust the government to those who trust physics, from those who hold promises to those who hold reality. The white elephant of the previous chapter, the luxury real estate, the yacht, the prestige asset, is a trap because it relies on a functioning system to give it value. It relies on a greater fool to buy it from you. Gold relies on nothing. It simply times as asterisk. And as the water rises, as the debt engulfs the system, as the currencies dilute into confetti, the only thing that will matter is what you can hold in your hand. But there is a catch. There is always a catch. Because when everyone tries to run through a burning door at the same time, people get trampled. The rich have already moved through the door. The central banks are squeezing through right now. And you? You are standing in the middle of the room, looking at the smoke, wondering if it's time to leave. You tell me, is it? Because the exit is getting smaller, and the heat is getting intense. But gold isn't just a shield, it's a mirror. It reflects the ugliness of the system back at us. And if you stare into that reflection long enough, you start to see the next terrifying reality. If money is dying and gold is fleeing, what happens to the people who have neither? What happens when the illusion of prosperity evaporates and all that's left is the hunger? We are done with the assets. Now we have to talk about the people. The forgotten, the angry, the ones who didn't get out in time. Turn the page. It's time to look at the streets. History doesn't repeat, but it rhymes. And right now the rhyme is terrifying. We are documenting every step of this collapse. Don't be a victim of the next crash. Subscribe to the channel, turn on notifications, and prepare yourself before the panic starts. It's better to be a year early than a day late.